You ever see a graphic that's so stupid that you want to talk about in a YouTube video? No? Well, I did. Today we're going to be talking about investing statistics that will make you think about the way that you're doing things. They may be something that goes along and makes you feel, yes, that is something that I'm doing that feels really good, or it's something that hopefully will change your viewpoint and get the discussion going in the comments. The reason why I wanted to make this video is I saw this graphic. It was a survey of Americans that had them respond on how confident they were that they could beat a specific animal in a fight. You look at it, 72% of people think that they could beat a rat in a fight. I feel like that number should be higher. But when you go down to it, chimpanzee 17%, those things are vicious. But the one that really blows me away is that 6% of people thought that they could beat a grizzly bear in a fight. People are stupid, and statistics really group people into categories like this. So I wanted to talk about some of the really interesting investing statistics that I found that have made me really think about the trends that we're going in and how we can improve as investors as a whole. There's no reason to kind of look at these statistics and go, okay, yeah, these investors are idiots. Here's how we're going to do it. We're going to talk about how we can try to push the narrative on how we can improve instead of looking at stuff like this and being like, people believe this is the best way to invest? I don't think so. 90% of people that watch my videos are not subscribed, so be sure to hit that subscribe button and let's get right into it. The first one is that investors have held stocks for 5.5 months on average, and this number has continually gone down over the past couple years. This 5.5 months is very recent. It's gone from the end of 2019, it was 8.5 months. It was 14 months 20 years prior in 1999, and the current average holding times are shorter than the record low average of 6 months that took place right after the Great Recession in 2008. The main takeaway that I get from this is that people are too worried about investing in the overall market. Obviously, there are awful things that happen when it comes to the way that the economy goes together with the stock market. And yes, sometimes emergencies happen and you have to sell your stocks. But it's the idea that people see the stock market going down, they see all these crazy giant red graphics that we see on YouTube. Maybe they go on CNBC and they see some of the headlines, but it's the panic that sets in as the market goes down instead of seeing it as an incredible buying opportunity. The stock market on average goes up 8 out of 10 years. And in the 2 years on average that it goes down, we really need to take advantage of buying the reliable stocks at a discount. That's why I've continually bought in 2021 and 2022 as the stock market has fallen, because I see these as buying opportunities instead of the panic button as, oh, we're going to take our money out of the market. Because as we know, humans on average are awful at trying to time the market. So when I look at this, I see this as people are either investing in too volatile stocks and the volatility has made them decide they needed to cut losses because their stock is down so much, or they're just not used to the possibility that the market goes down. When we look at younger investors, people most frequently got involved in the stock market in the past 2 years since the pandemic really started, when interest in the stock market really spiked. But since that time, we have not seen a lot of negative news stories up until the first start of 2022. So this is a lot of people's first bear markets and first time that their stock market has taken a major hit. And as a result, people are owning stocks for less and less time. We're trying to maximize our time in the market and not trying to time the market. So if you see a huge headline about your stock and it really makes you panic and wants to sell the stock, that may be an indication that your positions and your portfolio is too aggressive. And that's why I've made the switch in the past year to dividend stocks. I'll put a video up on the screen right now about the dividend snowball and why I think it's my favorite way to invest overall, and especially while the market is down. So that was the first statistic that really jumped out to me. Number two, 18% of Americans plan on investing more in 2022 than 2021. This is, a year old. 2021 was a fantastic year when it comes to the overall market, but it kind of goes along with this first statistic that people are more likely to invest when things are going well as opposed to when things are going poorly. We know all of the statistics about, bear markets on average last 14 months. So we need to take advantage of that. And just because you see that the market is down, you should see that as a buying opportunity and not a reason to panic. Yes, there are some stocks that I would not touch with a 10-foot pole right now because of the market conditions, but these blue chip stocks that have been around for the longest time and have the track record of surviving global conflicts, recessions, high levels of inflation, makes me confident in their abilities to recover much quicker than the overall market. So when I see this number, it shows that 62% say the current inflation rates are too extreme for them to take any action in the market. Inflation is the reason why your money is going down in value. And yes, you have some of the positives about the savings rates have gone up in bank accounts, but it's not going to outpace inflation. The only thing that is going to do that is investing in the stock market. And that's why it's so critical to put your money to work instead of just having it sit there. Yes, you'll see the interest rates start going up, and instead of getting 1 cent per month, you'll get 8 cents per month. That's a huge increase when you look at it percentage-wise. But you're not going to be able to outpace inflation, which is still relatively high, sitting around 7%. The one saving grace that I will say about this statistic is at the very bottom. In case you didn't read it, I'll highlight it again. 73% of Gen Z investors actively bought or sold stocks exactly because of the current market conditions, and 43% of them say that they'll invest more in 2022 than in 2021. So the younger investors on average are being more opportunistic when it comes to the market conditions, but we want to push that to everyone. We don't want it just to be the young people. We want it to be everyone, because the whole idea of investing in the stock market is that everyone hopefully can benefit from them instead of making rash decisions that are going to result in losses and some distrust in the overall market. Number 3 was a big one, and it's that 33% of people believe that real estate is the best long-term investment. If you are using surveys from the past year or two, that would make sense. We've seen housing prices go up significantly. We've seen interest rates be so low, so it's become a very attractive time to buy real estate, and people may think that is the best way to grow wealth for the long term. There are some positives to it. Yes, you can use leverage. That's kind of what the mortgage is all about. But it's the idea that we've seen this crazy level of price increases that are not going to be sustainable, and we've seen the housing market start to slow down significantly. So for people that bought at the end of the boom, their prices and their houses are probably worth less than they bought it for. And when we look at the long-term rates on how housing prices have increased over time, the numbers that I could find that the year-over-year increase on average from 1992 up until 2022 was 4.6%, which is a pretty nice return, especially when I mentioned people are able to use margin by taking out loans to really catapult their wealth as they start buying houses. But it's the idea that most people's money is tied up in their houses and it's not liquid. So you can be house rich and cash poor, and that's kind of the idea behind it. So let's compare it to how the stock market is done during that time. The website that I use only goes back until 1995, but from 1995 up until 2022, the S&P 500 had an average annual total return of 9.09% during that time, which is double what the housing market had done during that time. It's the idea that people view the short-term results as being able to extrapolate it for the future. If we saw the crazy increases in house prices that we saw in the past 2 years for the next 20 years, no one would be able to buy a house. So it's not going to go that way forever. It's just a short-term trend because of the overall market conditions that we already saw. So it's not going to be sustainable, and the housing market likely is not going to be the best place to invest, but you do have the positives of being able to put more of your money to work for you, because instead of paying rent to someone else, you're able to pay off your mortgage, which in theory builds equity for yourself. So that's a positive, but statistically, real estate is not the best place to invest overall when it comes to returns. Likely the stock market is going to be. And the final statistic that I wanted to talk about in today's video is that the median retirement account value for people underneath 35 in 2019 was less than $20,000. So we can look at this and say, man, people are really slacking when it comes to retirement savings. But the spin that I wanted to have on this is that if you are under 35 and your retirement account is between $0 and $20,000, you're not that far behind. It's the idea that retirement and just investing overall starts out really slow. You start putting in, $100 a month, and it feels really slow. You finally get to the point where it's $1,000 and it feels like a good win. And then you start looking to the future about retirement and how much money you're going to need to retire, and it feels really bad because the whole idea is if you're making 10% a year, which is what we're aiming for based on historical ranges, 10% on $100 is $10, and as we get up to $1,000, that's only $100, and that doesn't really feel like a lot, but it's the idea that it starts chugging along, it's the dividend snowball, you're pushing it down a hill, and as it starts picking up more and more steam, your returns are going to be more and more exciting. So while you're early on, the returns aren't going to be amazing, but it's the whole idea of trying to come up with consistent ways to invest, adding to it on a reoccurring basis, which is why I think reoccurring investments are so important. But it's the idea that if you're underneath that age bracket of 35, you may not be as far behind as you thought. You might need to take some steps to try to increase your savings rate so that you can save up for retirement more than you were doing in the past. But it's the idea that you can catch up relatively quickly. We've seen the Roth IRA contribution limits go from $6,000 up to $6,500. And this is one of my favorite ways about building wealth, because that Roth component means that it is post-tax dollars, so you've already paid taxes on it, but all of that money that grows in that portfolio is growing tax-free. So if you put in $6,000 this year and $6,000 next year, all of the money that comes from that is going to be tax-free as you decide to take it out by the time you retire. So there's so many positive ways that you can take advantage of being young and investing in the stock market. And just because you see your portfolio and your account size is really small at this point, that's not a reason to get discouraged and stop investing. It's a whole way of, it's going to start slow for a long time, but we're trying to build habits when it comes to investing. And after a while, it's really going to start picking up steam. And instead of making $100 a year, you're going to start looking down and, wow, you made $5,000 in a year. And it's really going to start taking off as you get older and older and start getting closer and closer to retirement age. So if you look at the graphics and you feel like you're behind, there's a chance that you can catch up relatively soon. It's a whole idea of if you start changing your habits now, you can build financial wealth for a lifetime, something that you can pass on to future generations. It's just the idea that you need to get the habit started now, and the best time to invest was yesterday, and the next best time is today. So these are some of the investing statistics that I thought were really interesting. It goes on stuff like savings rate, it goes on best places to invest, retirement accounts, and I thought it was really interesting. So let me know if which of these statistics you thought was the most interesting, and are you part of the 6% of people that think they could beat up a grizzly bear? Let me know in the comments down below. Up on one side of the screen right now are going to be 2 previous videos on investing and behavior on the stock market. And on the other side is going to be the subscribe button. I'm hoping to get to 10,000 subscribers by whatever date. Just trying to see that number increase for once. Thanks for watching. My name is Andy, and I will see you in the next video.